right. I think we can get started, Alex.
Great. Well, welcome everybody. It's nice to see a good turnout from all over, lots of different institutions. So thanks for registering. We've got an hour now to talk about this important topic. And in fact, you know, I don't need to tell you there's wildfires burning all over the world. North Africa, Italy, Greece, Spain, France, Canada, USA, everywhere, and we're clearly in a climate emergency. The disclosure regimes that we're talking about today are rooted in sustainability and climate emergencies, and it's easy to forget what the reason for this disclosure regime is, but it's part of a response to climate. Now, some people say that the responses aren't great enough. Other people find this too burdensome. We're going to talk about that in the session, but I think most of, and I hope all of you would agree that disclosure can play an important part in making the financial sector more transparent and reassuring investors, and leading to more company action and getting companies on a sustainability plan, a biodiversity action plan, and very importantly, a net zero transition. So the GIM was started also as a response to this a couple of years ago, growing out of an initiative by a group of development finance institutions and multilateral development banks to harmonize their measurement and reporting actually of positive impacts, not adverse impacts initially, jobs and economic growth, meeting SDG 8. But then we also added the functionality to measure GHG emissions, one of the principal adverse impacts. And today we're going to talk more about how we can add more adverse impacts. But planning a transition, I think, is incredibly important to toggle between positive and negative impacts. And the financial sector drives a lot of positive impacts. What we don't want is a rush to decarbonisation and divestment that destroys jobs and economic growth in financial portfolios. We want a managed transition, and that's why we think the joint impact model that we're talking about today can be helpful in planning that journey. So the thing I'd say is that there's more and more regulation. The SFDR has now been joined by the IISB sustainability standards, and there's more to come, and the existing systems, Global Reporting Initiative, Carbon Disclosure Project, they all remain as well. So it can feel as though there's a lot being asked, and therefore streamlined, harmonized responses are useful. But I think they're more useful for learning and action than they are for minimizing the burden on teams, even though that's a useful side benefit. So our call for standardization in this is not to make life easier, but it's to make learning more fruitful and to make action more meaningful. And I think it's really important to remember that once you've got your disclosures off your desk and sent them off to somebody, the real work starts, which is how are you going to reduce adverse impacts and increase positive impacts. So I'm going to hand over to Navia and Julia now. I should have introduced myself. I'm Alex McGilvery. I'm the Executive Director of the Joint Impact Model Foundation. I worked for 10 years at British International Investment, and I'm now pleased to be in the management team at the Joint Impact Model Foundation. So I'm handing over to Navia and Julia for the next 55 minutes.
Yes, thank you, Alex, for the introduction. So I'm Navya. Hi, everyone. I'm the Marketing and Business Development Intern at the Joint Impact Model Foundation. And today with Julia, we will explain the SFDR and the IFRS regulation and how the GIM can help you report on these. And then at the end, we'll end with a Q&A where you can ask any questions that you may have. So we'll start off with what is SFDR and IFRS and how it applies. How does it apply to fund managers and other financial institutions, the principal adverse in practice, and how the GIM can help with the pies. So if we move on, I'm sure you've all heard about the SFDR regulation, but I'll give a short introduction into what it actually is. So the Sustainable Financial Disclosure Regulation is a European regulation introduced to improve transparency in the market for sustainable investment products and prevent greenwashing. And it categorizes funds into three types, which are an Article 6 fund, which is the fund that does not integrate any kind of sustainability into the investment process, an Article 8 fund, which is a fund that promotes environmental or social characteristics, given that it has a good governance practice, and Article 9, a fund that has sustainable outcomes as an investment objective, also given that it has a good governance practice. And both Article 8 and Article 9 funds need to make sure that they do no significant harm to other sustainability objectives. And so the SFDR imposes comprehensive sustainability disclosure requirements covering a broad range of sustainability metrics, both at the entity and product level. And all applicable fund managers are required to make certain baseline disclosures on their websites, including sustainability risk management, remuneration policies, and principal adverse impacts. So moving on to the big question on who does the SFDR actually apply to? A common misconception is that SFDR applies only to fund managers based in the EU, but actually the SFDR applies to any fund managers marketing in the EU. So for example, an Africa-focused fund based in Mumbai that is marketing to limited partners in the EU is also subject to SFDR. And even if you're not directly subject to it, some additional considerations are that EU-based LPs could pass down reporting requirements to non-EU fund managers that are not directly captured by SFDR. Investors such as fund of funds that need to produce SFDR disclosures will be required to source data relating to their underlying investments and are likely to require additional ESG data from their non-EU fund managers. So it's still important to know what SFDR is and how you could possibly report on it. And moving on, if you are a fund manager or a financial market participant, you'll have to report on the principal adverse impacts, which are basically adverse or negative impacts of investment decisions on sustainability factors. So as of January 1st, 2023, fund managers with 500 or more employees are required to report on 14 mandatory PIs plus 2 voluntary PIs of their choice. And fund managers with less than 500 employees must adhere to the comply or explain rule, where they either comply with explaining how they consider these PIs or explain why they don't and how they will in the future. And if fund managers who do not have the data to report on all the PIs should apply their best effort basis and address gaps in their narrative disclosure. And so the 14 mandatory PIs are here, ranging from GHG emissions to hazardous waste ratio and board gender diversity. And moving on to IFRS, which I'm also sure you've heard about their new release of their S1 and S2, it basically requires to disclose material information about all significant sustainability related, which is the S1 part, and climate related, which is the S2 part, risks and opportunities to which it is exposed to. And here you have to consider the governance, strategy, risk management, and metrics and targets. And this approach was built on the pillars of the TCFD and actually has overtaken it. So something that is a critique of the IFRS is that it is single materiality, which only focuses on the impact of sustainability issues on the company and its outlook, whereas actually the SFDR and IFRS are more a double materiality, where they also report their impact on the wider world, such as the climate, biodiversity, and society. And one important thing to note about the IFRS is that it's not actually officially mandated, although the UK and China have expressed intention to do so, whereas IFRS and SFDR are mandated by the EU. And then moving on to reporting. So companies have to report on their sustainability and climate-related risks and opportunities that they seem relevant to their investments. And in addition, all companies have to report on the cross-industry metrics categories, which is part of the IFRS S2 standard. And this includes the absolute GHG emission measured in accordance with the GHG protocol on scopes 1, 2, and 3, and also the greenhouse gas emissions intensity expressed as metric tons of CO2 equivalent per unit of physical or economic output on scopes 1, 2, and 3. And so we're very pleased to actually see the focus on scope 3 in the new IFRS standard, as we have seen that depending on the sector, scope 3 can take up a majority of emissions, and we think it's crucial to solving the climate crisis that companies see what their supply chain effect is, even if they can't control it immediately. An important message is that for the first year of reporting, companies are not required to disclose their Scope 3 GHG, and they don't have to follow the GHG protocol to measure their emissions if they currently use a different approach. But the thing is, the GIM is already aligned with the GHG protocol standards, and this is not by luck that we already align with IFRS. It's because our methodology is based on sound principles, and we always apply best practice so that we are ahead of the curve. And now Julia will continue to explain more.
Thank you very much, Navia. So what I want to share with everybody who has joined here today is just some information about what we've seen in practice. As you guys know, June 30th was actually the deadline for submitting information about your PIEs. And so up to that deadline, we have been talking with a lot of fund managers and other intermediaries who are subject to SFDR. And through that process, what we have seen is we've learned a lot about the differences that even though this regulation is trying to align everybody's methods and metrics, what we're seeing is that there are still some very important differences that actually need to be discussed and addressed in the regulation. One of them is the difference between the Scope 3 emissions, which under SFDR, you have to include Scope 3, but it's not clear whether for financial institutions, you should be including the downstream activities, which would be the investments of the financial institutions. So let's say, for example, that you're an intermediary and you're investing in a financial institution. You could be reporting on the Scope 1, 2, and 3 of the financial institution as the institution itself. That would be, let's say, the tables, the desks, any other operations from the financial institution itself, any electricity that would be purchased by the financial institution itself, and then anything that would happen upstream, like the making of the tables, the construction of the facility itself, the branches. But as you can imagine, that would be a very, very limited amount of emissions from financial institutions as compared to the portfolio if they are investing in many more category. Could be agriculture, could be mining, could be oil and gas, actually, and then all of that would be excluded. And so for us, what we are showing you here is that the GIM does cover the investments part of the financial institution, which is category 15 of Scope 3. And we find that it's really important to include that, but it is still not totally crystal clear in the regulation. So sometimes we see some intermediaries and fund managers applying this, and sometimes they're not applying this. So I think that there's a lot of evolution that still has to happen from what we're seeing in practice. Let's see. So there's not just the issue of standardization in the regulation. We're seeing that across the board, even those who are not applying the regulation, that there's still a lot of differences. And there's a growing accusation of greenwashing or greenwishing when you're not actually aligning the reporting. And this is particularly true for if you're investing in a developing country, you're not going to get the data that you need. And that's why you need to do some modeling efforts. And that's where the GIM comes in. If you have an aligned method, if you have an aligned methodology that aligns to the standards that exist out there already, then what you end up with is a much more aligned approach. The other thing also that we are really focusing on is we're focusing on building a public good. So everything that we do is being published on our website so that anybody can take a look at what we're doing so that it's completely transparent. We see the GIM as a public good because we think that this type of modeling has to be done in a transparent way. And if you have, black box models where nobody knows what is actually happening behind the methodology, then that's when then the transparency actually decreases And this is very true for those investing in developing countries where these models are most necessary, or especially if you're investing in financial institutions where you are maybe once or maybe twice removed from the end borrower, then you have a lot of trouble with comparability. So that is what the GIM is. We've just established the foundation in May of 2022, but actually we've been working together with the DFIs and MDBs on this. Oh, sorry about that. The lights just went off here. We're trying, DFIs and MDBs, they've come together to build this since 2019. And our mission has always been to quantify impact, but always aligning with the industry standards. So we've aligned with PCAF, of course. We're aligned with SFDR. We're aligned with IFRS. But if the regulation evolves, then we would evolve together with that regulation. And our vision is to strive for an inclusive, aligned, actionable financial sector. So that ties into what Alex was describing earlier, that for us, it's really important that the final, let's say, step of the way is that there is action being taken so that we can actually reduce our emissions. That is, to us, the most important part. And now moving on to the pie reporting itself, what you can see here is you can see a little bit more detail around the different pies, especially these are the ones that the GIM is currently able to cover, pie number 1, 2, and 3. So these are all around GHG emissions. And some additional data that you would need to be able to get this information if you enter it into the GIM is how much you've invested, but also you will need the revenue figure from that. These two components, as well as the sector and the country, then you'd be able to get the outputs for the pies. And this is already available in the GIM. Something that we're really excited about for the version 3.0, which we'll be releasing in September, if all goes well, is pies 4, 5, and 6. And this is information that is additional to GHGs. This is about consumption of non-renewable energy. It's about how many companies are active in the fossil fuel sector in your portfolio. It's also about your energy consumption intensity per high impact climate sector. So all of these things we are very excited to be including for all of the users that are part of the GIM community. And what I would like to do now is I'd like to talk through what are the inputs that are actually required to use the joint impact model. Some of you that are here are already very familiar with the tool, so you can go back to emailing while I'm explaining this part. If you have questions about the input, this is also fine. You can put the questions up. But I would like to show you the input template, and I'll try to make it a little bit bigger. So what you can see here is you can see the input template as it currently is in the joint impact model. What you would need to enter is your client and your whether it's the code or not. And then you would just have to enter what type of client is it. There are several different options. It could be a direct investment, a financial institution. You could be investing in a fund, or you might be investing in a project that is in operational phase or the construction phase. If it's a fund, you can enter here the investee names. If you need to enter, of course, what is the fiscal year and what is the reporting year for yourself. What is the country? What is the economic activity? And the economic activity is, of course, aligned with NACE. So for SFDR, it's very important to align with NACE. But we also have ISIC and GICS, which the GICS we will be releasing in GIM 3.0 so that it is aligned with the needs from IFRS. And then you need to enter the revenue data for these particular clients. as well as if it's a project that is under construction, then you would need to enter the yearly project value. And then what you would want to enter also is the outstanding amount that you have invested in that particular project. I see that there's a question. I'm just gonna quickly take a look and see if I can. Okay, I will go into that. I will go into your question later, Ritesh. Thank you for posting it. And then if it's a financial institution, sorry, if we go back to this one, if this is important for PIs 4 through 6, if you have power production, then that's something that you need to enter. Typically, this is not something that we feel we can really estimate. It's something that you would need to ask your client or end borrower, what is the power production? And we normally see that this data is readily available. If you have direct data on emissions, then you can also enter that under the nice to haves. I'm not going to go into all the nice to haves definitions because we simply don't have time. But this just comes to show if you do have the direct data, then you can enter it here. And then the PI tool would automatically format it so that it's ready for the PI reporting. If you're investing in a financial institution, then you have several options. If you don't have any data about the financial institution itself, like for example, in this case, for Bank of Egypt, which is just a fictitious example, if you have miscellaneous, if you don't have the sector breakdown or sector granularity, you can just enter miscellaneous. You do need to enter how much you have outstanding, how much the financial institution has outstanding, and then the calculation will work. For this example, which is Bank of Chile, you might, if it's a financial institution, you might have the sector breakdown. And you just need to make sure that it's either in NACE, in ISIC, or in GICS. And then you need to have what is the outstanding amount that the FI has in these particular sectors. And if you are a fund and you don't have the investee level data, so you don't have company A, company B, company C, if it's just a sector agnostic fund, then you can also enter the outstanding amount that this sector agnostic fund has in each of the sectors that it's investing in. Okay. And then we have the attribution tab, which is of course aligned with the PCAF standard. Now there are some differences between SFDR and the PCAF standard, of course. But if you wanted to fill it out and align with the PCAF standard, you can do so here. And if you want to hear more about the differences, then I'd be happy to elaborate later on. But overall, if you're able to enter the information here, including what is your outstanding amount in each of the clients, then it would work. So what I can do next is I can show you the PI tool itself. So this is what the output would look like from the gym. So what you would see after you run the gym and after enter your results, you would see an aggregate. I don't know if it's too small. I'm going to try and make it bigger. Yes. You would see here the results for each of the clients, and it's all formatted in the way that SFDR would require it. And then it would all be aggregated as well and summarized, because the SFDR, it's looking for the results at the portfolio level, not just at the client level itself. And so that is why we have everything summarized here. And so this one, PI number 1 is basically the GHG emissions. And you can see here there are some. This is the methodology that we have that is in the regulation itself. And then you can see this is how we interpret the regulation from the GIM's perspective on a best effort basis. And so it's the same for the carbon footprint indicator. You can see here the final result, which is following exactly the calculation from SFDR. And then it's the same for the GHG intensity. So I'm seeing here a comment from Hannah. So the PI, we do have PI reporting available already. So if anybody needs it right now, we do have it available. In September, we will have PIs 4 through 6 available. So 1 through 3 is available now, 4 through 6 in September. I hope this answered your question, Hannah.
Yeah, I think so. I guess when I ran it, I used the joint impact model to then calculate PI reporting that I needed in June, and the results output that I got did not have these tabs.
No, this is a separate tool that we currently have available for those who need to transform their results.
Okay, so it wouldn't be, okay, so how, did you already go over, and maybe I missed, how to get this result as opposed to just the general GIM result?
We can have a separate call on that.
Okay, thank you. Thanks.
And if there's anyone else that wants to learn about how to do that now, you can just write it in the chat, and then I'll do a separate call for those who want to see exactly how to turn the GIM output into this. Just a note, Hannah, this will all be integrated in September so that you don't have to work with a separate Excel.
That'll be amazing. Thank you.
Yeah. So we know that because basically what you have to do now is you have to copy paste the output into this Excel, and then it transforms the results. But that can be quite cumbersome and prone to error, of course. And so what we want to do is that it's all integrated. So hopefully in September we'll have that release for you so that you don't have to worry about the separate Excels. But if you need it right now already, then we can have a call to go over how to work on it. But just know that in September it will no longer be necessary. Okay. So I see another question from Raki. Does that mean that for the balance pies, we will need this on our own GIM balance 9 pies? So are you asking, because we want to deliver pies 1 through 6, but then 7 through 9 we're also looking into? Is that your question?
Yeah, that's my question, because I think we have total of 14 core pies, right? Like that's the mandatory reporting. So if we have the first 5, my sense is for the balance, we need to kind of populate it on our own, on our side. And because GIM probably will have the mechanism to populate the other pies, but at some point you will kind of look at from 7 to 14 as well.
Yeah, so what I'm showing here, can you see my slide by chance?
Yeah.
Okay, great. So what I'm showing here is that 7 through 9, we are looking to include those. But then when it comes to 10 through 14, we're still not sure if we'll be able to include that, because the GIM is really about modeling at the moment. We're not looking to, at the moment, we're not looking to gather data direct. This is more about direct data, right? We might be wrong. We might be that in some cases you can do some more modeling. We know for sure that 7 through 9 modeling can be done and sometimes has to be done because that data is not available. But for 10 through 14, we see that more as direct information from the client that you need to source. But yeah, it's up for debate. But these ones for sure we want to include.
Understood. And do we know
Okay.
by when are you planning to look at incorporating 7 to 9?
Yeah, we're thinking that by 2025 we should be able to release a version that includes 7 through 9, which, yeah, it's not ideal, of course, because that means that what do you do for 2024? But yeah, we're going to be working as quickly as we can to include those. But for sure by 20.
Yeah, thank you so much.
Yeah. Let's see. And then I saw another question about benchmarks. So let me just take the question from Ritesh very quickly. That for the definition for companies active in fossil fuel, I think that's a very good question. We're going to be looking into exactly how to define that. We know that there is a definition that is limited, available from the regulation. So we're going to be diving into that, and however we define that, that will be publicly available in our website. Exactly how do we define what is what is considered as fossil fuel sector.
Okay, thank you very much.
It's a very good question about the supply chain, because it is not made clear in the SFDR regulation whether you should include the supply chain. What we were thinking about doing is including like may be at risk, right? Because we can actually count, we can actually show whether you are active in the supply chain with the fossil fuel sector, but then you would just be highlighting your entire portfolio. But anyways, great question. Let's see. And the benchmarks, that's another really good question. That's something that I don't have time to go over into today, but that is also in our plans to be able to provide benchmarking. But that will only be possible if the data is shared with the GIM Foundation. And right now, we're not doing any data collection at all, because a lot of this data is still, people are not so comfortable, fund managers and financial institutions. We don't see a lot of high comfort level in sharing data with anybody. We know that there's a lot of benchmarking attempts that have been done in the past, and we believe that we'll be able to do it, but it's something that we're still experimenting with parties that are willing to share their data. So we are looking into that as well. So I went through the Pi tool already, and I think we're doing well on time. So let me go back to the presentation. I already showed the Pi tool. So some more information about Pi's 4 through 6. Pi 4 through 6. So that's something that I already touched upon actually with the question from Ritesh. So we will be doing an automatic identification of the fossil fuel sector, and then we'll be providing a share at portfolio level, which will be automatically calculated in the output. We will also, for Pi number 5, this is the most difficult Pi that we had to tackle, because what it basically meant is we needed to get the energy consumption data at a country level, and thankfully we were able to get that data. We will be sharing, of course, in our methodology document how exactly we did that, but something that will be available also is total energy consumed, non-renewable energy consumed, also total electricity consumed, and non-renewable electricity consumed. So this is something that we're really excited about. We're working together with FMO on this, and we'll be making it available for all GIM members. So that's the beauty of this foundation, is that actually if anybody works on something and they want to integrate it into the GIM, there's a possibility to do that, and then it's made available to all the members. So this is a great cost saving, I would say, exercise that we are doing. Otherwise, each and every institution has to come up with a methodology, has to get the data, has to build a model individually. Well, with this, we can do more cost sharing, and so we're really happy about these type of additions to the GIM, which we think can be of great help to everybody. And then we have pie number 6. So this is about identifying the high impact climate sector. And this is based on the NACE codes as well. And the intensity would also be calculated automatically with the new version of the GIM. So as I mentioned already, GIM 3.0 will be released in September of this year. It will have pies 1 through 6 integrated. If the GIM Foundation intends to add pies 7 through 9 over time, we're thinking that by 2025 for sure. And something that I wanted to mention also is that there is a guidance document that will be released in September, I believe. It's written by BII and FMO, and it's supported by Akin Gump. And because of our experience with the pies, we were also able to provide our input to the document itself, just to share a little bit our insights of people that are actually trying to apply the pies. What are some of the challenges that we are seeing that they're having? If you want to make sure that you don't miss this guidance note, which will be publicly available, please get in touch with us, and we'd be more than happy to share it with our networks. This slide I already went over. I just wanted to, I'm not sharing slides like this. I just wanted to quickly explain that as far as IFRS goes, we're also aligned with their needs. So when we read what the metrics are and the categories, we're very happy to see that we are able to comply with them. And as Navia said, this is not by sheer luck. It's because we are, oh, sorry, let me just mute very quickly. We are able to align with these requirements. And the only thing that we need to work on further is the alignment with the downstream activities, which what we find is that it's very difficult to get downstream activities. But yeah, that's what we're busy with. So I've already been taking a lot of questions, but we are leaving some time for Q&A. Is there any other question from the participants?
Julia, we got a good clarification from Claire on the definition of fossil fuel exposure.
Okay. Okay. Thank you, Claire. Yeah,
no worries. I just took it from the template, the Annex 1 template for the PAI statement. So that's the definition that's included there, which is what we used when we did our report, which we issued last week.
I think like a lot of these things, Claire, the probably most companies in Europe get some revenue from the fossil fuel sector because even their treasury might be invested in a bunch of funds, some of which will have exposure to fossil. So I think there has to be some sort of materiality test. Otherwise, as Julia says, everything ends up in the fossil fuel sector at the moment, unless you've gone for kind of completely decarbonised funds. So I think there are various kind of fossil fuel materiality tests around kind of sometimes 5-10%, but at the moment I think the regulation allows for people to explain what their basis is, and I think the administrators of the regulation will have to kind of get their eye in as to what seems like a reasonable treatment here, or no doubt the accounting firms and expert consultancies will also come in with their guidance on where you can draw the line on your exposure of revenues here.
Yeah, and I think that goes for quite a few of the other indicators as well. I mean, this one is a little bit more clear than some of the other definitions, which really leave you with lots more questions.
Yeah, that's certainly true. It'd be great if we can, if we can build a community, as Julia mentioned, our sort of membership model. If we can build a community where some of these things can be worked out, then actually kind of gym members could kind of present kind of consolidated views on some of these things as the reporting regimes take off. It'd be useful to kind of be able to come up with some standard positions, particularly for people focused on portfolios in emerging markets and developing countries.
I'm very happy to provide my inputs to that because we are fully focused on emerging markets. So yeah, it's been quite hard to pull everything together.
Yes, indeed. Yeah, that's great.
Okay. There's another question on the chat, which says, how does info in IFRS S1 and S1, I think you mean S2, differ from the PI statement? And it's from Eliran. So Eliran, would you like to elaborate a bit more on your question? Make sure I interpret it correctly.
Yeah. So I just want to make sure if you provide the PI statement, because it seems as if it's already included everything under S1 and S2. Is that a correct interpretation, or am I missing something?
So we don't provide the statement itself. What the gym does is it provides the data,
The metrics, yeah.
and then you have to provide the statement. So that's what we mean by alignment, is just the third party, let's say, provision of data, which is allowed by both SFDR and IFRS.
Mm-hmm.
My understanding,
the same, right? Yeah.
My understanding is of the S2 on carbon is that it specifies for financial sector that it has to be broken down by sector according to GICS, and I don't believe the PI has that requirement for a sectoral breakdown, and it doesn't. And it's a different sector classification, more of an international one than the European one. So I think once you've got your input data, you can easily do both, but the format would look different. And I also think that it's actually more clear in the S2 that scope 3 emissions of your finance of your portfolio are required across all sectors. Those of you familiar with PCAF, there's some sort of uncertainty in PCAF about which sectors you need to include scope 3 for, with a rolling schedule between now and 2025. But IFRS have just gone straight for, from the 1st of January 2024, you have to report all scope 3 for all sectors. And I think that's kind of helpful clarification, although it means more work. And sort of from a selfish point of view for Jim and other people providing modelling solutions, it sort of makes modelling more useful, because in some sectors, there's really no way to do scope 3 without modelling. So to comply with the IFRS, you're going to have to do some modelling until you have full control over all of the suppliers of all of your clients, which could take quite a long time.
Yeah. Going back to what was said before about a platform for Q&A or some kind of a portal, is it something on the plan? I mean, you planning something, or is it already established?
No, it's not established yet. So we definitely want to, for gym members, we want to establish quarterly meetings, and it would differ between the topics. And this also ties into a little bit what Allison is asking about the heritage of the gym. For us, we want to build a community, and we want to have all sorts of, let's say, members in the gym. Right now, what we have is a development panel, and those are the DFIs and MDBs that are helping get this initiative started, right? And so they're backing us to be able to do all of this, and they're sharing their methodologies with us, so that we are able to share it further with the rest of the gym members. And as far as membership, anybody can become a member, as long as you're a financial institution and you're investing in developing countries. Now, when it comes to developed countries, That's something that is still under discussion at the gym, but at the moment it's really a focus on developing countries. Anybody who's investing in them and needs to use the tool for the reporting can become a member. And so what you were mentioning earlier about the Q&A, we want to have these quarterly meetings, or if it's necessary to have them more regularly for particular subgroups that are interested in particular topics. The gym actually covers a wide range. It's not just GHG emissions. We are also doing jobs and economic value added. And then we have particular focus groups and working groups that are working on improving the tool for that part of it. For this particular webinar, we're really diving into the SFDR side of it, which we are seeing is a very large need from a lot of our users and a lot of the members. But we're always looking on ways to learn more, get additional feedback from anybody who's using the gym, so all members, so that we can improve it further. And this also means that any member can share their methodology that they have internally with the gym if they would like to contribute in that way. So as we mentioned, we're a nonprofit, so anything that is shared with us would have to be publicly made available and would have to be transparently explained on how exactly we did that on our website. So as long as you're okay with that, and as long as you're okay with sharing it with more gym members, then that we're always open to hearing on different improvements, methodology, those type of things. Okay.
Brilliant, thank you.
Yes, there's a question from Raki Kulkarni. Yes. Do no significant.
Yeah.
Yeah.
I mean, for GHGs, I think the principle is every ton of carbon gets reported, even if it's 1 kilogram from a company. So I don't think the DNSH applies to GHG reporting, Raki, but maybe you've got a different perspective on that.
So
Yeah,
I
Raki.
thought there was a threshold that had to be applied for each of the indicator, and perhaps that is the DNSH threshold. So my understanding was that for every indicator for the pie, you need to kind of set up a threshold for your own investments or your own companies. So I was like, does Jim give any sort of guidance around how to apply that threshold? Or
I think our guidance is every ton does harm, and therefore every ton should be accounted for. And I think that's the intention of both the IFRS and the pie for GHGs. I think for some of the more qualitative metrics from 10 through 14, maybe there's a different principle that applies, but I think the others, it's absolute impacts with no cutoff.
So Raki, what I can do is I can take this question back to Akin Gump, who are putting together the guidance at the moment. So this is one of the areas that I think that can be further explained in the guidance document. So this is good input anyways, so that we can make sure that, it's clear in that document. So if there are any other, I think that this is a great opportunity to sort of understand what areas are unclear from the regulation. If you put them in the chat, we're not going to have all the answers, but if you put them in the chat, then I can forward that to the people putting together the guidance document, and we can review and make sure that the questions are addressed. So this is a good opportunity to get feedback from you in that way. And another thing that I wanted to mention, Alison, that we are close to or have already hit the mark of 200 financial institutions, DFIs, commercial banks that have requested access to the gym. As of September, we will be, when we will be releasing Gym 3.0, we will start charging for the model. And so that's going to be a big change, of course. So even though a lot of institutions have requested access and started utilizing the gym, we don't know how many of those will actually be converted to paying members of the gym. We're hoping that there will be a large majority which will do so. But yeah, that also remains to be seen. So you can see there that out of the 200, when we're thinking about the DFIs and the MDBs, it's really becoming a minority now. So the majority is going to start to become more of impact investors and commercial banks that are actual gym members. Okay, so we have a very specific question from Hannah. It was unclear, so I can go back to the Excel so we can take a look at exactly how it's done. If the denominator has should be in millions of euros or numerator.
Yeah, and this was, I mean, for the one that we did in June, we just sort of picked something and explained and went with it, but we found that some peers did it differently and got a result that was like 1 million times different, literally 1 million times different than ours, because depending if you do ones or millions. So for example, yeah, the one that you're showing right now, GHG intensity, the current value of the investment, that looks like it would just be current value in ones. But then the bottom says current value of all investments in millions of euros. So if you literally do it that way, then you'll get a very different result than if you do them both in millions.
Yes,
I think the intention should be to get tons per million euros invested. That's the kind of standard format for emissions intensity reporting. So if that's not clear in the PI guidance, that's useful feedback that we can aggregate and pass through. But I recommend doing that because it'll make your kind of benchmarking efforts easier with what other people have disclosed. That's the standard approach. I mean, other people outside Europe will be doing it in tons per $1 million, but it'll get you into a very similar place in terms of benchmarking.
So could you just say then A or B of what I said? Should the numerator and the denominator both, whenever there are monetary values, should they be in the same units despite being written as different units?
No, so only the denominator should be in millions. So what we have here, what we have here is, you see here the current value of all investments is divided into 1 million. So I can share the sheet with you, and then you can look at exactly how we've interpreted the calculation methodology. But you can see these are the total. This is the total GHG emissions. So that is the combination of these three. And then it's only in the denominator that it has to be per million, because what you want in the numerator is the total value of investments. And the nice thing about this, having this Excel sheet, is that you can then understand there, it's completely open and you can follow the calculations so that you can really understand. You can understand what was done. Yeah. Right.
So the current value of investments, that cell F17 is the current value of investment divided by investee company's enterprise value summed up for all the investees. And then and also when you say total emissions, it's the attributed results. So it's also taking into account your
this one,
share of
attributed results. Yeah, you can see up here. You can also see where this information is sourced from. We can do that in an individual call, Hannah, but you can see exactly which page this is sourced from, which is this one. And for this one, it's attributed, but for PI number 3, I believe they're not attributed.
So I think, so this is for carbon.
Yeah, they're not attributed for PI number 3, but then you have the same thing here where the current value of all investments is again per million. But let's have an individual call because I want to make sure that I get through all
sure.
the questions.
Thank you.
But yeah, it should be clear from the regulation, and indeed, like Alex said, it does align with the other benchmarking initiatives out there. So I see another comment from Claire. Yeah, that is a good question. So we'll definitely send it to Akin Gump to make sure that it's included. So for this Excel file, what we're doing actually is we are sharing it with those who commit to becoming gym members once it comes out in September. Ritesh, I'm not sure which institution you're from. But we can get in touch and we can discuss what the yearly fees are. They're designed to be as minimal as possible. We just want to be able to cover our costs. As I mentioned, we're a nonprofit, but we do need to be able to cover our costs. And so what I'm doing, what we're doing is we're sharing this particular Excel file with those that have approval from their management to become gym paying members in September. Just quickly mute.
IFRS sustainability.
Oh, sorry. I didn't know she was asking a question. Sorry about that. Unmute. Sorry, Doris. I thought it was you were talking in the background. My apologies. Could you please unmute yourself and ask the question again?
No, sorry. Go ahead. Sorry about that.
No, you can. Did you have a question about? I heard you saying SFDR, so I wasn't sure if you had a question.
No, go ahead, Julia.
Okay.
Thank you.
Okay, yeah. No problem. Sorry about that. Okay, almost out of time. Any other question? No? Okay, so I think that we did an okay job getting all the information in. Thank you, Aslam. And as I mentioned, we are collecting feedback from this session. If anything is still unclear, please let us know. Then we can send it over to Akin Gump, and we can make sure that everything that you are unsure about will be discussed in that guidance document, so that you are, so that you're getting the help that you need for this crazy regulatory landscape that we all have to navigate through.
The regulatory landscape and the learning as well, once you've got the numbers, right? Because
yes,
the key thing here isn't to file your report with the regulator. The key thing is to plan your decarbonisation and sustainability journey. And this is the data you need. So there's a bigger purpose to this beyond the disclosure. It's great to have other people look at your results, but it's even better for you to look at them.
Indeed. Thank you, Alex.
But great. Thanks, Navia and Julia. That was really interesting. Thank you very much, and thanks very much for all of you for having joined us for the last hour. We've got some good questions and some good feedback as well.
Yes, indeed. Thank you, everybody. Have a lovely rest of your day, and if anything, please get in touch with us. Right. Bye-bye.